Hey everyone, welcome to the weekly dividend recap for the week ending July 14th, 2023. I am Nick, host here on the Dividend Growth Income channel. Thank you for joining us today. I'm working on bringing this series back where at the end of the week I put out a short synopsis of all the latest news around dividends and dividend growth investing. If this is your sort of thing, please consider liking and subscribing to help me out with that elusive YouTube algorithm and be part of spreading the amazingness that is dividend growth investing. In today's episode, we're wrapping up the 28th week of 2023. And folks, I'm just a regular guy, okay? I'm not a financial advisor or guru. Nothing here should be taken as financial advice. This is meant for entertainment and educational purposes only. And with that said, let's get right into it. All right, the S&P 500 has had another solid week, gaining 2.5% over the last 5 days. Year to date, the market is up 17.8%. Rallying from March 10th and still going strong. And this is mostly being carried by about 6 or 7 mega cap tech stocks. Think Apple, Amazon, Nvidia. Now the top dividend ETF, SCHD, has also had a strong performing week, up 1.66% over the last 5 days. But year-to-date shares of SCHD are still down about 2.73%. So there's definitely not a lot of hype for SCHD right now outside of dividend investing circles. But it's hard to argue with that triple trifecta of solid price appreciation that rivals the broader market. You're getting a healthy dividend yield, which is going to be more than double what you're going to get on the broader market. And you're also getting above average dividend growth. Here are the current top 10 holdings in SCHD where it stands right now. It's a who's who of blue chips with Broadcom, UPS, Cisco, Texas Instruments, Home Depot, Pepsi, Merck, AbbVie, Verizon, and Chevron, making up the top 10, over 40% of the entire fund. Alright, let's look at some happenings around our favorite companies this week. I'd like to talk about Domino's Pizza first, ticker DPZ. Everyone in the civilized world knows Domino's, and they surged this week on news of a deal made with Uber Technologies. Now, Uber has been in that group of hype stocks this year, and it's done extremely well, up nearly 76% year to date. So headlines like this did a lot to raise the stock of Domino's. Now in the last month, shares are up over 18%. Granted, much of this hype bringing the price up could be a bit of market overreaction. Domino's really is a wonderful business that does so many things the way we like from the perspective of a dividend growth investor. We actually highlighted this one back in, I think it was April, as an intriguing opportunity. With these restaurant businesses, there's usually a little bit more risk to keep in mind. And Simply Safe Dividends gives Domino's a score of 55. I think that's a fair score here. It's not a lot of yield. You're getting a starting yield of 1.26% on shares today, but that comes with double-digit dividend growth. Over the last decade, Domino's has greatly outpaced the broader market. Your total return holding Domino's over the last 10 years would be 578%, compared to the 225% roughly you get from investing in SPY or VOO. With the recent hype, I don't think this is a deal right now like it was earlier in the year, but Domino's does belong on any serious dividend investor's watch list who has some time on their side and room for risk, higher reward. They buy back a ton of stock, earnings and free cash flow increasing every year, year over year. So I really think the future is bright for Domino's. Do keep an eye on their debt. It is on the high side. Okay, let's move along. This is another lower yield, high growth dividend stock. Really a fantastic business I personally have been buying into. They reported today. They surged on earnings today, and I'm talking about United Health Group, ticker UNH. UNH, like many managed healthcare companies, has been in the dumps this year due to increasing costs. But UNH came out today, released earnings today, announcing beats on both earnings per share and revenue. Revenue came in at $92.9 billion, which grew 16% year over year. Earnings from operations up 13% from last year. They did see a small rise in their operating cost ratio. But its outlook for the remainder of 2023 has been strengthened. Shares rose 8% today after being in the dumps for the last couple of months. Those of us who've been buying were given a nice little boost and some vindication today. There's something to be said for the reliability of this managed healthcare business and their own position in the sector, really as the leader. I see them as the leader. They're the largest. Now, shares are still down over 7% year to date. I'm still a buyer of UNH stock. I did add another $100 to my position back on Wednesday. And I covered this pretty extensively in my last video too, which I encourage you to check out at the end of this episode. Okay. What's next? Oh boy, we have Walgreens Boots Alliance, ticker WBA. Now, Walgreens this week, they broke their 19-year streak of raising their dividend payout every July. This is a company that's paid a dividend uninterrupted for 91 years, and their dividend payout remains a top priority for the company and management, but their business has suffered considerably, and they've not managed to get things together as fast as we investors would like. Their margins are razor thin at the moment. Look, margins are typically weak for retail all across the board. That's a weakness in that industry, but they're really being squeezed to the limits here. Walgreens is the worst performer in my own dividend growth income portfolio. Buying into it really was a yield-chasing mistake I made. None of us are perfect, right? Now, since I last reported on this, SimpliSafe Dividends has downgraded Walgreens, their dividend safety score, from 79 to 70 due to the squeezed margins I discussed, as well as the fact that the current Walgreens dividend is not covered by free cash flow. Now, to put that in another way, think of it like this. The amount of money it's costing Walgreens to pay this dividend, their free cash flow this time does not meet that amount. A dividend that is not covered by free cash flow, well, that money's got to come from somewhere else. And then companies are going to go into debt to take out just to keep that dividend streak alive, or they'll issue more shares. Basically, this is a mess right now. I'm exiting my small position. Video coming in the next week here on the 3 options I'm considering to replace my small position in Walgreens. So make sure you have the notification bell clicked, because sometimes the algorithm gives my channel a bit of a rough time. This will ensure you're kept in the loop on this one. And while the safety of Walgreens dividend, look, it's an undeniable concern. I'm not going to say a dividend cut is imminent here. I have other reasons for exiting this position as well. I'm going to get into that in the next week's video, okay? Now, I know a lot of people have positions in Walgreens. Some of you sold out of it. Others might be looking at it right now for the yield or as a value, a turnaround play. So I'll make sure we keep up to date with the latest around Walgreens. Let's move on to a few of the dividend raises announced this last week that were on my radar. The first I want to talk about is Enterprise Products Partners, ticker EPD. It's an oil and gas storage and transportation business classified as an MLP. Now, on July 10th, EPD announced a 2.5% dividend hike. This is the second dividend raise announced within the last year, bringing its total bump up 5% over the last year and making the 24th consecutive year EPD has raised its dividend. They've managed to continue raising through the last recession. It looks reasonably valued right now by dividend yield theory and by the price to distributable cash flow. If you're good investing in oil, you need to understand the tax implications of investing in MLPs, where you will be issued a K-1. This can be tedious, and these do trigger tax liabilities and tax sheltered accounts, so it's really not worth putting these in a retirement account, any kind of tax advantaged account. Let's check out this 7% bump we have from Cummins. Yes, Cummins, ticker CMI. They are an engine maker. They have announced their 17th consecutive dividend raise, and this marks 30 years without a reduction. Their dividend was maintained in the last recession. That 7% raise is right in line with their average dividend growth rate over the last 5 years. SimpliSafe Dividends gives them a safety score of 98. And there are a lot of fine choices in that industrial sector for dividend growth investors. But if you want the next payment for Cummins, that's $1.68. You need to have your shares by August 24th, 2023 to get paid on September 7th, 2023. This is a March, June, September, December payer. And looking at its metrics from its PE and from a dividend yield theory perspective, Cummins is sitting around its fair value and perhaps belongs on your watch list. Next, we have popular utility company Duke Energy, ticker DUK. They have announced a 2% dividend raise for their 16th consecutive annual increase. With Duke, you're investing in stability. They are one of the top regulated utility companies on the market, and they're based out of North Carolina. Now, to get the next dividend payment of $1.02, you'll need to have your shares by August 17th for that September 18th payout. This brings the forward yield to 4.39%. This is sitting about 6% above its 5-year average. Shares of Duke are trading at a 16.3% forward PE, which is about a 10% discount to its own 5-year average. So if you like Duke, you're looking for some utility exposure, this could be a decent time to add to your position. I do think there are a few better choices in utilities right now for dividend growth investors, but Duke is solid and dependable. And what have we here? We have J.M. Smucker. This is a packaged food company most renowned for their peanut butter and jelly products, as well as their Folgers and Dunkin' coffee. These are iconic brands. Now, on July 14th, Smucker's announced they were raising their dividend by nearly 4%, lifting their quarterly payout from $1.02 per share to $1.06 per share. This pays out March, June, September, and December, and this raises for that next payout on September 1st. You do need to have your shares by August 17th to get that next dividend payment. This marks the 22nd consecutive year Smucker has raised its qualified dividend, and just a few short years away from dividend aristocrat status. Look, peanut butter and jelly is a cash cow. These folks are the undisputed leaders as far as that goes. And I bet if you walk down into your kitchen cabinet right now, I bet you one share of SJM that you would be finding some of their products. They have one more excellent company that announced a dividend raise on July 14th, and that is National Retail Properties, ticker NNN. They declared a 56.05 quarterly dividend, which is a 2.7% increase from their last dividend of 55 cents. Shares of NNN are trading at a forward yield of 5.23%. This is the blue chip real estate investment trust with $7.88 billion market cap and a secure dividend rated 80 from Simply Safe Dividends. This marks the 34th consecutive year NNN has raised their dividend payment. You want to have your shares by July 28th to collect those sweet dividends on August 15th. Now, do you hold any of the stocks that we talked about that raised their dividend this week? Let me know down below in the comments. And if you don't own them, are any of them on your radar? And I want to move by talking about the CNN Greed and Fear Index. This is supposed to be a measure of investor sentiment and what emotions are driving the market. And today that index is at 80 in extreme greed territory. And you know what the great Warren Buffett says? About being greedy when others are fearful and fearful when others are greedy. Not easy to put into practice all the time. Now, in times like these, I do prefer to stick with quality. I've been very focused on companies like UNH, the reliable blue chips, companies where I can put my money, sleep well at night, knowing that my investment is going to work for me, raising my passive income. Now, if you want to see the other stocks I'm buying in July, go ahead and click into this next video. Thanks so much for sticking around, my friends, and until next time, keep investing.